It's 2 a.m. in the morning. The blue glow of the phone screen is the only light in the room. You've been scrolling through charts for what feels like hours, but it's only been 20 minutes. Your portfolio, the one you checked proudly at dinner, is now swimming in red. One particular coin, the one you bought after watching that one YouTube video, is down 7%. A single, thick, red candle on the chart. Your heart does that weird double thump thing. Your thumb moves on its own, hovering over the sell button. There's a voice in your head, loud and clear. It says, cut your losses. It says, protect what you have left. So you tap the screen. A quick, sharp digital click. The sell order executes. A wave of immediate relief washes over you. The threat is gone. The number in your cash balance is safe, solid, unmoving. You put the phone down and finally try to sleep. 14 months later, that same coin is trading for 3 times the price you sold it for. You're not even looking at the chart when you see a tweet about it, and you feel it. That deep, hollow ache right in the center of your chest. It's not anger, really. It's a quiet, profound regret. You played it safe, you protected your capital, and you lost out on life-changing money. That sound of the sell order clicking, that sigh of relief. That was the paper hands tax getting paid. And you never even saw the receipt. My name is Sam, and I want to talk to you about that tax, not the one you file with the government. I'm talking about the sophisticated, multi-layered system of financial and psychological costs that activates every single time you sell in a panic. We've been sold this idea that selling a dip is the smart, responsible move, that taking small profits is playing it safe. I'm here to show you the data that proves that instinct, that feeling of safety, is one of the most expensive illusions in crypto. It's a tax system designed to systematically drain your capital and your sanity. And today, we're going to audit it. Let's start with the first and most brutal layer, the math tax. This is the silent compound killer. When you sell to avoid a loss, you think you're locking in a certain, smaller number. What you're actually locking in is the loss of all future compounded gains on that asset. You are trading uncertainty for a guaranteed mathematical penalty. One single missed major run can completely wipe out the gains from a dozen of your successful small profit trades. Let me be clear about something. Selling to buy back lower isn't a strategy. It's a hope dressed up in a spreadsheet, and the math is stacked wildly against you. Let's actually do the numbers. Say you sell Bitcoin at $50,000. You're in the US, so that's a short-term capital gains tax hit of, let's say, 20%, plus the exchange taker fee, a tiny 0.1%. You sell 1 Bitcoin. The exchange gives you $50,000. You immediately owe $10,000 in taxes. You have $40,000 left. You pay your 0.1% fee on the way out. That's another $50. So your net cash from the sale is $39,950. Now, your plan is to buy back cheaper, right? For this to be a winning move, the price needs to drop enough for you to buy back more times Bitcoin than you started with. But let's just see what it takes to simply break even. To get back to your original position, you have $39,950. To buy Bitcoin, you pay another 0.1% taker fee. So the actual amount working for you is $39,950 divided by 1.001. That's about $39,911. To buy a full Bitcoin again at a lower price, the price needs to be at or below $39,911. Let that sink in for a second. You sold at $50,000. To just get back to where you started, to have 1 Bitcoin again with 0 profit, the price needs to fall to $39,911. That is a drop of over $10,000, a drop of more than 20%, just to break even, not to make a profit, to get back to zero. Your brilliant plan to sell the dip required the market to crash more than 2% just for you to tread water. The asymmetry is absolutely brutal. This math tax is the entry fee. It's the toll you pay just to get onto the roller coaster of trying to time the market. But it gets worse. Let's talk about opportunity cost with real data. Look at Bitcoin's history from 2017 to 2023. If you had simply held through the 10 largest drawdowns, those gut-wrenching 30% plus drops, your total return would be in the ballpark of 8,500%. Now, what if you were a paper hands trader? What if you sold during each of those scary drops? If you missed just the top 3 recovery rallies after those crashes, your return doesn't just get smaller, it plummets. We're talking falling from 8,500% to maybe 400%. A single decision to sell during the March 2020 crash, to cut losses at $4,800 and then buy back a month later at $7,000 because you felt safe again, would have left you with 46% fewer coins than if you just held. That's not a paper cut. That's a permanent, non-recoverable amputation of your position size. The math tax doesn't show up on your monthly statement. It shows up years later in the form of what you don't have. Now, you might be thinking that the math is cold and the market is unpredictable, that the psychological relief of selling is worth something, and that's where we get to the second layer of the tax. The psychology tax. This is the depreciation of your mental capital. Every time you make a paper hands decision, it isn't just a financial transaction. It's a withdrawal from your finite, non-renewable bank account of clear thinking and emotional resilience. And this tax compounds into chronic stress and worse decisions down the line. Here's what nobody in the trading space will tell you. They won't tell you because if you knew this, you'd trade less, and the entire ecosystem profits from you trading more. Neuroscience shows us that the pain of regret is 2 to 3 times more powerful than the relief of avoiding a loss. Think about that. The agony you feel when you sell a coin and then it pumps 10x is psychologically 2 to 3 times stronger than the relief you felt when you sold it during a 5% dip. The paper hands cycle is a net negative emotional machine. It's designed to take more from you than it gives. You sell for relief, but you're actually just taking out a high-interest loan of future regret. And the interest on that loan is paid in cortisol, your stress hormone. A study on day traders, people who live this cycle hourly, showed they experience cortisol levels comparable to fighter pilots and police officers in high-stress situations. This isn't excitement. This is systemic stress. That cortisol flood leads to decision fatigue. It means your 10th trade of the day is significantly more likely to be impulsive, emotional, and poor than your first. You think selling relieves your stress. In reality, it just initiates a more expensive, long-term stress cycle of chasing, regret, and constant vigilance. You end up paying the psychology tax by burning out your own ability to make good choices. Let me give you a scenario. Meet Alex. Alex is 29. He's a smart software developer. He's got a $15,000 portfolio. He follows crypto Twitter. In the last quarter of 2023, he finds a promising altcoin, does some research, and buys $5,000 worth at $1 per coin. A week later, it dips to 85 cents. An influencer he follows tweets, "Weak hands getting shaken out." Alex feels targeted. He feels foolish. To protect his remaining capital, he sells at 82 cents. After the tiny fee, he nets about $4,000 back. He feels smart. He saved himself from further loss. 45 days later, that coin is at $2.50. Alex's original $5,000 investment, if he had just sat on his hands, would have been worth $12,500. Instead, he has $4,000 in stablecoins. And he's not thinking about his saved $1,000, he's only thinking about the $8,500 he missed. So what does he do? He feels behind. He needs to make it back. That $4,000 charged with regret and frustration gets thrown into the next shiny coin he sees. The psychology tax has done its job. It has depleted his mental capital. And now it's pushing his remaining financial capital into a hasty, high-risk decision to compensate. This is the spiral. But the system isn't done with Alex yet. There's a third partner in this crime, the efficiency tax. This is the layer where the ecosystem itself, which is financially incentivized for you to trade constantly, takes its direct cut. Fees, slippage, and the bid-ask spread. For a paper hands trader, these aren't just costs of doing business. They are a subscription fee for misery. A guaranteed wealth transfer from your pocket to the exchange and the market makers. Traders see a 0.1% fee as tiny, invisible even. They don't see it as a guaranteed, compounding performance leak that actively works against their goal of making money. Let's do an overtrading autopsy. Follow a fictional $10,000 through a year of paper hands behavior. Let's say you get spooked and sell a dip, then buy back in 12 times in a year, once a month, not even that crazy. And let's be incredibly generous and say every single trade is a perfect break-even on price. You sell at the exact same price you buy back at. You're just spinning your wheels. Each round trip, a sell and a buy, with that 0.1% take a fee each way, costs you 0.2%. So your $10,000 goes through this. 10,000 times 1 minus 0.002 to the power of 12. Do that math. $10,000 becomes $9,763. You have paid $237 in direct fees for doing nothing, for making zero profit. Now add in the real-world slippage from using market orders because you're panicking, which can easily be another 5 to 10 basis points per trade. You're now over $300 gone. $300! That's a 3% annual drag on your portfolio before you've even made a single dime. Compare that to the drag for a diamond hands holder. It's near zero. They pay a fee to get in and a fee to get out years later. That's it. You are paying a 3% annual tax just for the privilege of being stressed and reactive. That's your invisible subscription. And who's cashing that check? The platform you're using. Let's look at another scenario, one that feels even more responsible. Meet Sarah. Sarah is 42. She's more cautious. She buys 2 Ethereum at $1,800 each. Her cost basis is $3,600. It goes up to $2,200. That's a 22% gain on her money. She thinks a 22% gain is great. I'll take safe profits. No one ever went broke taking a profit. She sells. After her fees and her long-term capital gains tax, let's say she nets a clean $800 profit. She feels fantastic. She did the smart thing. Then, over the next 8 months, Ethereum consolidates, dips a bit, and then goes on a run to $3,500. If Sarah had just held her 2 Ethereum, they'd be worth $7,000. After a long-term tax hit on her gain of $3,400, she'd walk away with about $5,960. Her safe profit strategy netted her an actual realized gain of about $800. The risky hold strategy would have netted her about $2,360 after tax. Her fear of volatility, her desire for safety, cost her $1,560 in actual realized gains. That's her safety tax. It's not theoretical. It's the money she could have had in her bank account, but traded for a fleeting feeling of security. So we have the 3 taxes silently draining you. The math tax that slams the door on future compounding, the psychology tax that burns out your decision-making engine, and the efficiency tax that siphons cash directly to the exchange with every panicked click. They work together as a system. And this brings us to the forbidden truth, the big reframe that changes everything. We think of this as a choice between safe profits and risky holding. That is a false choice. That's the narrative sold to keep you trading. The real choice is between the certainty of multiple hidden taxes and the uncertainty of simple market volatility. One path, paper handing, guarantees a complex, multi-layered drain on your money and your mind. The other path, holding, only exposes you to price movement. Up and down, that's it. One is a guaranteed leaky bucket. The other is just a bucket that sometimes feels lighter, but has no holes in it. Here's another way to see it. When you paper hand a dip, you haven't exited crypto. You haven't gone to cash. You've just executed a hyper short-term, high-stress, fee-intensive trade. You sold an asset with the intention of buying it back soon. That's a trade. The diamond hands holder, ironically, is making a calmer, longer-term, low-fee trade. They are buying and holding. You are buying and selling and buying and selling. You are just choosing a frantic, expensive time frame. They are choosing a patient, cheap one. The ultimate realization, the real aha moment, is this. Your constantly churned portfolio, the one you check 20 times a day, isn't the main product of this activity. The main outputs are stress, regret, fatigue, and fees. Your mind is the product. Your emotional state is the commodity being sold to the adrenaline rush and the exchange's revenue stream. The portfolio is just the byproduct, and it's often a shrinking one. So, what's the move? Your assignment isn't to become diamond hands overnight. That's not realistic for most people. The goal is awareness. Your first job is to audit your own last year for this paper hands tax. Open your exchange history. Calculate your own efficiency drain from fees. Really look at it. Notice the psychological withdrawals. How did you feel after each panic sell? How long did the relief last compared to the regret? Start by designing one simple rule to reduce one layer of this tax. Maybe it's, I will never sell an asset within the first 72 hours of buying it, no matter what. Maybe it's, I will only check my portfolio once a week on Sunday afternoon. Maybe it's, I will calculate the break-even downside required before I ever hit sell using the math we did today. The goal isn't perfection, it's to see the tax. Because once you see this system, once you understand that your instinct for safety is triggering a sophisticated extraction mechanism, you can't unsee it. And that awareness, that moment of clarity, is your first real step to keeping what's yours. In crypto, action feels like control. But inaction, the simple, hard act of doing nothing, is often the most controlled and strategic move you can make.